All right, so this is part two of our chapter seven notes. And really, a lot of part one was review. Okay. Make sure you brush up on it, make sure you understand it. These items will be very much brand new pieces to receivables that were not covered in Intro to Accounting. So, basically, we're talking about financing arrangements with receivables. Now, what does that mean? Well, financing tends to revolve around us either issuing debt, acquiring loans, or issuing equity, right? Those are the typical ways of financing our company's operations and their business model. However, we can structure financing arrangements that involve our accounts receivable. So this will occur perhaps if the company needs cash immediately, right? Then they can utilize this asset they have to obtain enhanced liquidity. Remember, receivables are liquid, but we have our cash and equivalents. That's our first most liquid piece. The second is marketable securities. And the third is accounts receivable, right? And accounts receivable, we expect to collect these typically within 3 months, but that might not always be the case, right? Maybe a company is having some issues with their accounts receivable turnover, which means that they're just not able to collect as frequently as they need to in order to sustain their business model. So there's really two types, two main types of using receivables through a financing to secure financing in a manner that actually turns accounts receivable straight into cash without waiting for our customer to pay off their account. The first one is a secured borrowing, also called a signing. And what we're doing here is we use the receivables as collateral in a loan agreement. Okay? So collateral means basically someone loans us money. If they loan me money and there's collateral involved, what that means is I have to put up an asset of mine. If I don't pay off that loan with the person who gave me money, the person who gave me money can take my collateral. So the one that is the most obvious to most people and the one that we're most familiar with is a mortgage. And a mortgage is just a loan that has the home as collateral, right? If I don't pay my mortgage and I don't pay it and I'm delinquent for a number of months, then the bank can come and seize my home. So collateral is important, right? You might ask yourself, well, why do they do this with receivables? Why not just borrow money? Well, collateral reduces the risk of default, and therefore you get a better rate of interest. Um, the other transaction, instead of just pledging and assigning our accounts as collateral in a loan, is just to sell the receivables. And this is called factoring. Okay. When we sell our receivables, right? When they're collateral, we still hold our receivables. We do not remove them from the balance sheet. But when we actually sell them, then we remove them from the balance sheet. They are no longer my receivables. I sell them to another party. They collect from my customers. So first, let's figure out whether the transaction is borrowing or sell. So whether it's the first, a secured borrowing where we assign or pledge receivables, or it's a sale where I remove them from my books and sell them to another party. So if and only if all three of these pieces are met, can we call this a sale? Otherwise, it's just a secured borrowing. So when we transfer, so this is language from the codification. The transferred assets have been isolated from the transferor. So it has, fun legal-ish contractual language. The transferred assets in this case are the receivables, and they have been isolated from the transferor. So that means that title has been exchanged, that I cannot obtain any information about the receivable and whether it's been collected while it's with the person that I've transferred it to. The person I've transferred it to can then turn around and sell it or sell a portion of it to a third party, right? So that this is just another level of ownership. Like I have all the rights and privileges to take what I was sold and then sell it off again. And then the person who sold it, the transferor, doesn't have some amount of control over it or the right to repurchase it again. So there's not this sort of I sell it to you now, I buy it back from you 3 months later agreement, which happens sometimes in various business transactions. So as long as we've isolated the receivables from the seller, that the seller, the person that we sold it to, the person we sold these receivables to, can turn around and sell them to a third party, and the person who sold the receivables isn't going to be able to repurchase those receivables at any point, then we've met the conditions of a sale. Otherwise, it's a secured borrowing. So let's talk about the secured borrowings. And there really are two types of secured borrowings. Assigning is when we have specific receivables pledged. I'm sorry, well, specific receivables. I'll just use the word assigned. I don't want to get it conflated with the other one as collateral. So we go through and we're like, yep, Bob Company. That's when you can take Jones Company, you can take Smith Company, whatever, right? Just those customer receivables are now the ones that you can take as collateral. If there are not specific receivables assigned, then it's called pledging. So the collateral consists of any receivables. If we are just having any of the receivables as collateral to this piece, then there is really no special accounting, just disclosure. Remember, disclosure means all we're doing is putting something in the footnotes to the financial statements. So, for example, we might have an agreement where we can draw upon a line of credit with a bank, and we pledged our receivables as collateral to that line of credit. A line of credit means that I haven't borrowed any money yet, but I can borrow on that line of credit. And the bank might say something like, okay, well, you can borrow up to 90% of the receivables that you own at any given time. When there are specific receivables that are assigned as collateral, well, then we have a little bit of accounting that has to go along with it. In the case of pledging, the company who's borrowing the money, the person whose receivables they are, they go about their business and collect receivables from customers just as they would normally. In the case of assigning, that collection can be done by the company who's borrowing or the company who is lending to the borrowing company. Okay, just depends on the terms of the agreement. But again, in either case, remember these are just collateral for either a line of credit or a loan. Right? So they agree on the specific receivables, right, that we're going to allow to serve as collateral. The assignor, the borrower, can make collections on the assigned accounts, right? And if they do, then any amount that is collected from those particular accounts is remitted or sent to the person who we borrowed from, plus any interest that has accumulated. Okay. So basically, we collect the accounts and hand the money over, and we pay interest before any principal on our loan. So the assignor recognizes all of the discounts, returns, and allowances, bad debts on their financial statements. They still have ownership of these receivables, and so the risks of ownership remain with the company. The assigning example here, and I have the journal entries already laid out so you can listen and work with any of the additional annotations I make here instead of worrying about the actual entry itself. The first piece tends to involve a reclassification of the accounts receivable. So we want to basically designate the specific receivables that we identified as collateral. And so we take whatever accounts those might be, we credit them out of just our normal bucket of accounts receivable and assign them the name assigned accounts receivable. This is just a reclassification. And so there's no movement to any affects assets, liabilities, or equity. It's just an asset for an asset. Now, we will record the loan proceeds from this assignment. Notice that, right? We assigned $40,000 of receivables, but KLP Finance is only going to extend 90% of the receivables value in cash to my company. Why are they not giving me the full amount of these receivables? Because they know that receivables can have discounts associated with them. There can be returns associated with receivables, and there can be bad debt or credit losses associated with these receivables. So they will never give us the full value of cash. They're protecting themselves a little bit. And then the borrower is like, okay, you can take, I'm assigning these receivables as collateral in exchange for a 12% note to finance my company, right? And KLP, the finance company, is also going to take a little bit of a slice off the top, a financing fee for this transaction. So those details are what inform our loan proceeds. Notice that the note payable is set at 90% of the receivables assigned. So it's just 90% of the 40,000, and that gives me the 36,000. Now, why didn't I get $36,000 of cash? Because of the service fee charged on top of this arrangement. So they're protecting themselves from discounts, returns, and allowances, um, credit losses by not giving us the full 40,000, and they're also going to charge us a fee on top of that because that's what financial institutions like to do. So rather than get 36,000, we only get 35,500. Now that increases my assets cash. The service fee is a reduction to net income, just like the fees in our bank reconciliation. And the note payable is, of course, a liability, and that increases liabilities. Now, that's just a proceed from a loan, so not anything terribly complicated there. When we record collections, right, we got to make sure we do this appropriately. And I'm collecting, my company, Merrick is collecting. They collected $29,200 of cash from the assigned accounts receivable. And when they did this, right, we had some people who acted within a sales discount, right? So they got $29,200 of cash, but $800 was not collected because our customers paid within the discount window. And that's just the cash discount accounting right there. And we credit the assigned receivables for that full amount. So the assigned receivables are being reduced. That's crediting assigned receivables reduces assets. Of course, I get that cash. That's an increase in assets. And remember that the sales discount account is a contra revenue account. So that reduces net income. Now, the company has to turn around and remit this cash to the person who loaned the money to KLP. So they're going to take this $29,200 and shove it right back out the door after their collection because now we're remitting payment to the lender. So the 29,200 starts our journal entry. Credit to cash for that amount reduces assets. Now remember, right, this is at the end of the month that we're doing this. So during the month, we collected these receivables. We got $29,200 of cash. We had some sales discounts. That's great. So that's the month of January. But at the end of the month, we have to remit that amount to the lender. And remember that there was a 12% interest rate attached to this note. And these are always, unless otherwise stated, annual rates of interest. So to calculate the amount of interest, I take the amount of the loan, which was $36,000. That's in my note payable account. I apply the annual rate, but then I acknowledge the fact that only 1 month has passed of the 12 that represent the 12%. That gives me interest expense of $360. I pay off that interest expense, and then the rest goes to pay down the amount of the loan. And it's just a plug in our journal entry, or it's 29,200 less the amount I paid in interest expense to get 28,840. So this will, of course, reduce our liability and reduce net income with the interest expense that we recognized. So just to make sure that we know how much this note payable is sitting at, because we are paying it down, so we need to track that in order to record interest. It started at $36,000, and we just paid down 28,840 of it with a debit. And so now we have only a balance remaining. In this case, that's 67,160. So this is my remaining balance after remitting payment. All right, we haven't paid it off yet. We haven't collected all our receivables yet either. Remember, we assigned 40,000, we only collected 30. So now in February, we collect more. We collect $7,800 of cash from the assigned receivables, and we had a write-off. We wrote off a $200 account of our assigned receivables as uncollectible. So it's a combination of a collection and a write-off in one entry. I have the $7,800 of cash and the debit to my allowance for doubtful accounts or allowance for credit losses. The cash received, of course, increases assets, even though this is a contra account, a contra asset account. Debiting it still increases assets, just like a normal asset account. And I reduce the assigned receivables by 8,000. So all I'm doing is exchanging assets for assets with these collections here. When I remit to the lender here, I'm remitting, remember, take the 7,800 as your starting point. But in this case, wait a minute, the 7,800 exceeds the amount of the loan that remains. Right? What am I talking about? Well, remember, I only have 7,160 up here. So I don't have to pay off I don't have to give them over and above what I borrowed. I do have to pay off interest. And so I pay off the entirety of that balance. 7,160 is now gone. But remember interest. I had 36,000. I reduced it by 28,840. That left a balance of 7,160. I'm going to, again, it's the end of February when I'm remitting payments. So I have that 12% annual interest, but there's only 1 month of it being applied here since we're only talking about the month of February, which resulted in interest expense of $71.60. So that's recorded as interest expense, reducing net income. The $7,160 note is paid off. And the amount of cash that that took is just the addition of those two items, $7,231.60. And that's going to reduce my cash. I'm sorry, reduce my assets. Now, once I get rid of my payable, it's settled, it's extinguished, any amount of receivables that had been assigned but were not used to pay off the note can be reclassified back to general accounts receivable. They're no longer collateral. We ended our borrowing arrangement, so the person we borrowed from can no longer seize them as collateral. And for that, we just need to track how much we collected from our assigned accounts receivable. Initially, we had assigned 40,000 to this assigned receivables balance. We collected 30,000 of that amount, and we collected 8,000 of that amount, which left 2,000 remaining. And that's why now I can credit the rest of this and dump it right back into my general receivables account. Just an asset for an asset once again. If I assign an extreme amount of my receivables specifically to pay off loans, if the amount is significant, then we need to have a separate AR, right, in the current assets section somewhere. Sometimes I've seen this listed in other assets. Sometimes it's listed just right below accounts receivable, right? If it's not a material amount, then we just need to disclose. Remember the difference between recognition and disclosure. Recognition is for significant, relevant material events. Disclosure in the footnotes is less prominent, therefore reserved just for lesser events, less relevant, immaterial, less significant. And we should, regardless of whether it's material or not, have a description of this financing arrangement included in the notes to the financial statements. And we need to specify, the material accounts that have been set aside as collateral in that financing arrangement so that our investors are fully aware. So let's look at one more example of this. Punisher secured a borrowing by assigning $75,000 of its receivables in exchange for a 10% promissory note. So instead of 12%, this one has a 10% annual rate and 95% of the receivables assigned. So it only got 95% of the total that it assigned. The lending firm is charging a fee of $200 on all borrowings. So let's record the initial entry here. Remember, first, we're going to designate the assigned receivables. So we'll debit assigned receivables or assigned AR and credit our normal AR, 75,000. All of them were assigned, but remember, we're only going to get cash minus a fee for 95% of the receivables assigned. So 75,000 times 95% is equal to 7,000 or let's see, not 71,000, of course. That's not definitely not 7,000. I was about to say 70. but $71,250. So this is the amount of cash they would be giving to us, except that we also have a $200 financing fee on this. So we're going to get $71,050. That's the amount of cash that I receive for assigning these particular receivables. We have a finance fee or a service fee. I don't mind what you call it as long as you reduce net income. And of course, we receive cash for that, $200. The note that we have to pay off is for the full amount, $71,250. Okay, if Punisher collects $35,000 of the assigned receivables and remits that amount to the lender, what is that going to look like? So first, we have to do the normal collection on receivables. We debit cash for 35,000 and we credit assigned receivables for that amount. Sorry, I forgot to identify some effects up there. I will in a moment. That's an increase in assets. This is a reduction in assets. The note payable is an increase in liabilities. And of course, the assigned AR to AR, they're both asset accounts. We're just being specific with the receivables we assigned. Now we got this cash, but since they are now assigned, we have to turn around and remit that cash to the person who lent us money. So we're going to credit the cash that we collected, 35,000. But before we start paying off principal, we got to get that interest. The interest is going to be on the principal amount of the note payable, 71,250, multiplied by the interest rate here, 10%, and adjusted for the fact that we only had a month of collection here. And that amount comes out to a number that we will likely want to round. $593.75, but I'll just call it $594 of interest expense. Just to simplify the dollars. Remember, you're allowed to round when you want to. As long as you show me your work, I can tell you're doing the appropriate things. And we're going to subtract that off of the $35,000 payment. And that means that we're going to end up paying off the remaining amount of cash goes to pay off the note payable for 34,406. So that reduces my liability as I pay off the principal. That reduces my net income. It's a non-operating expense. And oops, sorry, wrong way for the asset. It reduces my assets because I had to remit that cash to the lender. Okay. The next video that I put up will deal with factoring, which tends to be a little bit different of a transaction than assigning, where we actually sell the accounts, remove the receivables, and involve some special accounts for us to consider. Right? That was equal to 594.